Okay, folks, it's time. I'm going to get started as people join in. We're on the home stretch here, right? We have only a few more weeks of class left, and if it sounds like I'm nagging you on the project, it is because I'm nagging you because we're getting close to the end. So each week you'll see me kind of up the ante and say, "Where are you on the project?" But are there any questions before we get started on capital structure there? Okay. So today we're going to kind of extend what we were talking about last week. So last week, let me go back and review. We talked about the trade-off on debt versus equity, right? The benefits of debt primarily are tax benefits with the added advantage of added discipline in some companies. The consequence of borrowing money in terms of costs are bankruptcy costs, agency costs, and the loss of flexibility. It's actually a very powerful way to think about why some companies can afford to borrow money and others cannot. But it doesn't give you an answer. It doesn't give you a specific number. So if I asked you, what's the optimal debt ratio for your company? That approach doesn't lead you to a specific answer. So I offered an approach which came right out of our investment analysis. So take a look at the cost of capital. And if you can find the mix of debt and equity that minimizes your cost of capital, the lowest cost of capital you can get, that's your optimal debt ratio. So in terms of mechanics, here's all we do. We change the debt ratio from 0 to 10 to 20 to 30. And in each debt ratio, we compute a cost of equity based on the levered beta and a cost of debt, acting like a ratings agency and rating the company entirely on interest coverage ratios. Along the way, we keep track of the fact that if we have interest expenses that exceed our operating income, we lose tax advantage. But the net effect is we end up with an optimal debt ratio for a company. We tried that with XYZ widget company. Kind of an unsatisfying experience. But I tried it on Disney, and the basic mix I came up with is 40% debt, 60% equity. Now, what I want to do is flesh out what that means for Disney as a company. So let's review. Right now, Disney is at about a 12% debt ratio. They're about $16 billion in debt. And based on my analysis with the cost of capital, I'm telling them to go to a 40% debt ratio. That's about $55 billion in debt. And I'm going further, right? I'm asking them to borrow $39 billion, which to begin with is a huge amount of debt, and buy back stock or pay dividends with that debt. That's a hugely consequential decision. And my guess is if Disney is doing its job, it'll have at least 3 questions to ask and get answered before it jumps down this path. And these are 3 generic questions that always come out of a capital structure analysis. The first is, why should we do it? You're saying, that's obvious, your cost of capital will go down. You're going to see how, so if I try to use that sales pitch on you, you're going to say, you want me to do what? To get what? It's not going to look like it's big enough. So I'm going to first talk about why a company gains by going to its optimal. Second, and this is a question to always ask when you borrow money, whether as an individual or companies, what if something goes wrong? What if there's a recession? What if there's a lawsuit? What if something goes wrong? And third, what if instead of borrowing money and buying back stock, I mean, remember, Disney has all these big plans. They want to build more theme parks. They want to expand into streaming. What if I took the debt capacity and used it to reinvest in the company? Would the analysis be different? So let's start with the first question. Why should we do it? I'm going to start by looking at the standard answer. Your cost of capital go down. So let's review what the cost of capital will in fact do if Disney goes to its optimal. Right now, Disney's cost of capital is 7.81%. That's at the 12% debt ratio, their existing debt ratio. If they go to their optimal, which is 40% debt, their cost of capital decreases to 7.16%. 7.81% to 7.16% is 0.65%. I'm asking them to borrow almost $40 billion to lower their cost of capital by 65 basis points. Now, do you see why companies are not easily convinced by cost of capital arguments? The cost of capital for a big company, a mature company, will not move very much. So here's what I'm going to try to do. I'm going to try to make it real money. And to do this, I'm going to go back to what I started with at the cost of capital discussion. I said, you can use the cost of capital to value Disney as a company. So what I'm going to do is I'm going to value Disney as a company using the existing cost of capital first, and then I'm going to revalue Disney as a company with its new cost of capital, and let's see how much its value goes up. So first step in valuing the company is to come up with the cash flows of the company. So I'm going to do a very simplistic valuation here because obviously a full-fledged valuation, you've got to wait till we get to the end of this class. So I took their after-tax operating income, 6.4 billion, added back depreciation, subtract capex, subtract change in working capital. If that looks familiar, that's how we got cash flows for a project. The cash flows for Disney as a company is 3.65 billion in the most recent year. As I said, I'm going to keep things very simple. I'm going to assume that I can use a stable growth valuation model, which means to value Disney as a company, I'm going to take my expected cash flow next year, 3,657 grown out 1 year, and divide by cost of capital minus the growth rate. It's a perpetual growth equation. I actually know what Disney's enterprise value is right now as a company. So when I look at how Disney is being priced by the market, the value is about 133.9 billion. You're saying, so what? Here's what I'm going to do. I don't want to sit here estimating growth at this stage in the process. That's not my end game here. It's to focus on capital structure. So here's what I did. I took the existing value of the firm, I took the cash flows and growth rate and solved for what the growth rate would have to be to end up with this value. So I have the cash flow, I have the cost of capital, I'm solving for a growth rate. I'm going to call that my implied or imputed growth rate of 4.9%. Given how Disney is being valued by the market now, its cash flows and its existing cost of capital, its growth rate is about 4.9%. And I did something very simple. I took the cash flows and the growth rate and held them constant and changed my cost of capital from the 7.81% to the optimal cost of capital. And something truly magical seems to happen. The value of the firm, which used to be 133.9, jumps to $172.9 billion. My value as a company increases by almost 39 billion. We're going to come back and talk about where that increase in value comes from. And it's a little cynical to call this value enhancement, but it clearly looks like Disney's become a more valuable company. Now, those of you in my valuation class probably already know I'm breaking some rules when I do this with Disney, because this 4.94% growth rate is too high a growth rate to maintain forever. Now, one of the proxies I use for long-term growth in the economy is the risk-free rate. My risk-free rate was 2.75%. Using a 4.94% growth rate, I'm pushing this model to the point of breaking down. So here's what I did just to kind of keep myself, to get a more realistic number. I said, you know what, this firm value approach is giving me too high a number because I'm using the model with a 4.94% growth rate. I'm going to try something else. One way to think about your cost of capital, though we almost never think of it this way, is right now, this is what I'm paying as a company to finance my entire company. So let's see where we are. Right now, my value as a company is 133.9 billion. At the existing cost of capital of 7.81%, I'm getting a cost of funding this company of about $10.45 billion a year. So if they keep their existing cost of capital, it's costing them 10.46 billion every year to fund the company. If I go to my new debt ratio and a lower cost of capital, that annual cost drops to 9,592. So all I've done is change the cost of capital. It saves me $866 million a year. This is permanent. I'm going to have these savings every year in perpetuity. And if I use the risk-free rate as my growth rate, the increase in value that I get for Disney as a company is $19.6 billion. That's 65 basis point change in the cost of capital increases my value at Disney by 19.6 billion. That's magical, right? Now do you see why this push behind LBOs, it's the L that's often driving the BO, because everything else is it's the leverage that's driving the increase in value. And I hate to be cynical here, but think about where that increase in value is coming from. It's the same company, same projects. All I'm doing is changing the mix of debt and equity. So where is this 19.6 billion increase in value primarily coming from? Nathan, do you have any thoughts on where this increase in value is? They're not taking better projects. Same theme parks, same movies, same broadcasting. All they've done is change the mix of debt and equity. Where is this increase of 19.6 billion coming from?
I'm sorry, I'm not sure where it comes from if you change that ratio.
Fabian, you have any thoughts? Because it looks almost magical, right? I'm doing nothing, changing the mix. So where's that increase in value coming from?
Would it be coming from taxes?
Exactly. The next time an LBO guy talks about increasing value, slap him around the face saying, no, you're not increasing value. You're just transferring value. Do you see why it's a transfer of value? Where is the value being transferred from and to whom? It's being transferred from taxpayers to the equity. I'm not saying it's unethical, immoral. They're playing within the rules of the game. But what's happening here is because of the way the tax code is written, debt is given an advantage over equity. This 19.6 billion is almost entirely coming from the tax code. You know how we can tell? If I change the tax rate to 0% for Disney, you know what its optimal debt ratio is? Teresa, you want to guess? If I've changed the tax rate to Disney for Disney to 0%, what do you think the optimal debt ratio will be?
Would it be the same
It's going to become
as
0.
before you lowered it?
It'll become 0%. If I have 0% tax rate, the optimal debt ratio is 0%. Why? Because I've taken away your biggest reason for borrowing money. I've left you with all of the other consequences. You take any Middle Eastern company. Remember, I said the Middle East is one of the few parts of the world where interest doesn't get this tax reduction. The optimal debt ratio for every company is 0%. Their value is actually maximized when they use all equity. The primary rationale for using debt is the tax advantage you get from debt, and plays out as an increase in value. Now, of course, I'm also bringing in the bankruptcy and the agency costs. I'm being realistic, but with the realistic cost built in, my value still increases when I go to my 40% debt ratio. Any questions on the change in value, where it comes from? Because this is, I think, fundamental. People talk about value enhancement, and the primary vehicle for value enhancement becomes changing your debt ratio. This is not value enhancement that we collectively benefit from as an economy or a society, because there is no change in value from the investments you're making. It's almost entirely coming from the way the tax code is giving an advantage to debt. Kushal?
Professor, if you go to the previous slide.
I can't hear you, Kushal.
So can you hear me now?
Yep.
If you go to the previous slide,
Mm-hmm.
In the current enterprise value, should we not use the new debt, like include the new debt in there as well?
No, you should. You should, because in a sense, this is when you look at the current cost of capital, the current cost of capital reflects the current debt ratio. Right? I'm just looking at, I know the current enterprise value, the current cost of capital. So when I use the current cost of capital, I'm also looking at the current debt ratios. The enterprise value that goes with the current debt ratio is the 133.9.
But then that's giving you a higher growth rate, which we're then using in the revaluation.
Why? It's giving the same, the growth rate is 4.84% in both cases. The only difference, the revaluation, is my cost of capital is lower. Right? So when you look at the two numbers, the only number I'm using that's different is a cost of capital of 7.16% of 7.81%. So step two is primarily to get the growth rate. That growth rate stays constant. But now I'm saying, what if I had a different mix of debt and equity? What would my enterprise value look like? Now, let's assume that you've managed to convince the Disney board that this is the right thing to do. Because after all, no matter what the reasons are for the increase in debt, their job is to take care of their shareholders. In this case, it looks like their shareholders would be better off if they went out and borrowed money and bought back stock, right? So I ask you a very simple question. When we go out to buy back stock, we're not going to be able to buy it back at the existing stock price. Why? Because you make an announcement that you're going to buy back $39 billion worth of stock and you're borrowing the money. Everybody knows what you're doing. They say, what price should we pay on the buyback? So let me give you the limiting example. In a perfect market or when investors are rational, what you'd have to pay, and then we'll talk about deviations from the script. So let's say you're all Disney shareholders, pre-change in debt. And let's assume you have 1.8 billion shares outstanding. So this is before I make the announcement, there are 1.8 billion shares outstanding. So I make the announcement to you. Every one of you does what we just did, works out the increase in firm value. So you all estimate the change in firm value to be 19.6 billion. It's very unrealistic because we might each bring different assumptions, but let's say we all agree on the assumptions. So every one of us has a $19.6 billion increase in value. We know that the company is going to go out and borrow money to buy back shares. As a stockholder, you have a choice, right? You can either sell your share back to the company when it does the buyback or hold on to your shares. Every one of you has that choice. If you're rational, I need to make you indifferent between the two choices. You know what I mean by that? In other words, you should feel just as good selling your shares back as holding on, which essentially also means that everybody will get an equal share of the 19.6 billion, the people who sell their shares back and the people who hold on. So here's what I did. I took the 19.6 billion increase in value, gave a slice of it to every single shareholder. The increase in value per share that I get is $10.90 per share, which added to the current stock price gives me a value per share of 78.61. So here's what I'm going to do. I'm going to go out and buy shares at this price, 78.61. So Mallory sells her shares back to me. She's going to get $10.90 more per share than the price is today. But if you choose not to sell your share, guess what you're going to find the price to be after this is all done? You also will get the $10.90 increase. Everybody will get the same share of the increase in value. And that's why we call it the rational solution, because nobody's being made better off or worse off. But let's say you are a large shareholder in Disney. You want to do this buyback, but you don't want to sell your shares back. You want to end up with the biggest slice of the company. Would you, when you go out to do a buyback, do you want to pay a low price for the shares you buy back? Remember, you're going to be the remaining shareholders in the company. If you're going to set the price for the buyback, would you want to buy the shares back at a lower price or a higher price as one of the remaining shareholders? Jeremy, what do you think?
Sorry, if I'm selling or buying?
I'm sorry, go ahead.
No,
Jeremy,
can you?
Okay, here's what
I said, are you selling or
you're,
buying?
You're one of the shareholders in the company, right? You're going to, let's say you're going to be managing the buyback and you plan to remain in the company. Would you want to buy the shares back at a lower price or a higher price?
I want to buy them back at a higher price. So that,
but the people who sell the shares back then will get the benefit from the buyback, right? In other words,
right,
you're
but
going to be
wouldn't that,
left over. Yeah,
wouldn't that increase the price overall, which then increases?
Well, you're
price of
giving
the stock,
away a
right?
bigger slice of the 19.6 billion then to the people who sell their shares back. You're going to be left with less rather than more, right? I mean, I can see what you're saying, which is if I can push the share price up in the buyback, it'll stay up, but it'll stay up only if there's something backing it up. If there's only 19.6 billion in the pie, you want to give as little of the pie as you can to the people who sell their shares back. In fact, you'd love to sell the shares back at the existing stock price. It's very unrealistic, but let's say there are some really stupid shareholders out there who never read the news, who never watch CNBC. They have no idea that Disney is doing this. And let's say you could buy the shares back at 67.71. See why this is going to help you? You're going to buy the shares back at the old price. You're going to get to keep the entire 19.6 billion for yourself. Your increase in share value will be much, much higher as a remaining shareholder. So one solution is if you can, but if you hire an investment banker to do the buyback, you've changed the game, right? What does the investment banker want to do? He wants the buyback or she wants the buyback to go really smoothly. And to make your buyback go smoothly and have it kind of go through really fast, you're going to offer a higher price rather than a lower price. In fact, left to their own devices, bankers say, let's say pay $90 per share. The people who sell their shares back are going to be delirious then because they're getting $90 per share. Those loyal shareholders who are left over are going to end up with a much smaller slice of the pie. So the pie here is 19.6 billion. The question is, who gets it? Is it the people who sell their shares back or the people remaining? And what determines that is the price at which you buy back the shares. Michael?
Yeah, in the first scenario where you're playing the 78.61 per share,
Yeah.
so then the company essentially then paying out their entire upside of switching their to their
No, they're giving the slice of the upside. So let's say 30% of the shares are sold back and 70% are going to stay in the company. 30% of 19.6 billion will be paid to those people who sell back. So they will get their share. The 70% who remain will get 70% of the 90. That's why it's rational. Everybody will end up with $10.90 more per share. Any other solution, somebody's winning, somebody else is losing. In fact, here's the more general way to solve for who wins and who loses. So first, you got to figure out how much debt you have to increase. So in the case of Disney, that's 39 billion. Then you got to figure out how many shares you're going to buy back at whatever price you pick, right? 70, 75, 80, 85. That's going to give you the shares left over after the buyback. Then you compute what your equity value will be after the debt is borrowed. Remember, you're going to go out and borrow additional amount. And the value per share you get after the buyback then will reflect whether you're a winner in this case by staying in the company or a loser. And that $10.90 will then become your break even as to how much or which side wins and which side loses. I know it sounds incredibly abstract. So let's take this extreme scenario. Let's assume I was able to buy shares back at $67.71. So if I borrow 39.175 billion, that's how much I have to borrow to go to the optimal. Buy back at 67.71, the number of shares left over is going to be 1.22 billion shares, fewer shares outstanding. My enterprise value, if you remember, was 153,531. That came from the increase in value, plus cash, minus the new debt, 55,136. The value of my equity is 102.3 billion. You divide by 1.221 million shares, the value per share you will end up with as a remaining shareholder will be $83.78. You remember what it was in the rational case? It was 78.61. By being able to buy the shares back at the old price, your increase in value will be greater because you're one of the remaining shareholders. So if you can buy the shares back at less than 78.61, you will get a disproportionately large share of the 19.6 billion and end up with a higher share price. If I bought back at that rational price, let's see if it works out. So basically, I buy back at 78.61. The number of shares outstanding is 1,301.65. If you look at the remaining value, 102.3 billion, and divide by the new number of shares outstanding, so both the people who sell their shares back and the people who remain in the company end up at 78.61. So this was in my response to Michael's point. If I can buy the shares back at that rational price, everybody gets $10.90 more per share. And if I pay more than 78.61, you could try any price you want. Try 85, try 90, try 95. You can try any price you want. You can see who benefits and who loses from a buyback. A company that does a share buyback without a reservation price. You know what I mean by reservation price? A price at which they say, okay, we're not going to do the buyback. This is too high a price. Risks giving away value to the people who sell their shares back at the expense of those shareholders who remain in the company. Now, one of the things that that Berkshire Hathaway did in 2000, until 2013, Berkshire Hathaway never did a buyback. They paid only dividends. And in 2013, when they first started buying back shares, they actually added a component to their buyback that very few other companies did, which is they had a value per share that they said, that's our intrinsic value per share. If we will buy back shares if the price is less than the value, but if the price pushes above the value, the buyback will be suspended. Now, we might not be able to get a precise value per share, but it's a good idea to have a reservation price. In this case, if I had an investment banker, I'd say, look, I want to buy back shares on one condition. I don't want to pay more than 78.61 for those shares. And if it's going to cost me more, then we're not going to do the buyback. I can still borrow money, but I'll pay a dividend instead. Remember, there are two ways you can return cash. You don't have to do the buyback for this process to work through. Any questions on the mechanics of how cost of capital plays out in change in value? I know it's a lot of moving pieces. What I would suggest is take the Disney example, try different prices, try 80, try 85, try 90, see whether you can work out what the remaining shares will be worth and who are the winners and who are the losers. And after a while, you get a sense of what it is that drives the value transfers that happen during a buyback.
Why did you make the long-term growth rate 4.8%? Isn't the long-term growth rate like 3% for the US economy, or is that for the world economy?
Well, the 4.8% was a solved number. Basically, what I did was I took the existing value and I just solved for what growth rate would give me the value. I said, look, I don't know what the growth rate is. I'm going to let the market tell me. And the reason I did not go through with this increase in value, you didn't see the 39 billion being the number I talked about, is that 4.9% is way too high. Way too high. In fact, I wouldn't even try to estimate a growth rate in the US economy. There's a very simple number I can compare the 4.94 to, which is my risk-free rate. Once you get above the risk-free rate, if your growth rate is above the risk-free rate, you don't want to use a perpetual growth model. That's why I reverted to the other way of estimating the change in firm value, where I did cap the growth rate at 2.75%.
Okay, thank you.
So let's take the second question. Anytime you borrow money, this is a question worth asking and answering, right? What if something goes wrong? And there's almost no company where this question will not come up. And there are a couple of ways you can address this. One is you can do what-if analysis. I'm going to tell you the variable that is the most critical one in the capital structure spreadsheet. And some of you are going to be surprised, some of you might not be. But that variable is the operating income. This is an approach to estimating optimal debt ratios that based on how much money you make. So you can ask what if questions. What if my operating income were lower, 10% lower, 20% lower? What will happen to my optimal? So one way to see if you can get comfortable with the optimal debt ratio is to see how sensitive it is to changes in your operating income. Just a second. When I told you the optimal debt ratio for Disney was 40%, I based it entirely on the cost of capital being lowest at that debt ratio, right? I never even checked the rating. Do you remember what the rating was at 40%? Because clearly the ratings should have decreased. What if I told you that the rating for Disney at its optimal debt ratio were BB? I'd wager most companies would say, I'm not okay with that. A BB rating puts me below investment grade. Bad things can happen to me. Remember those indirect bankruptcy costs we talked about? So the second thing you can introduce in this optimal capital structure to kind of give yourself protection is say, look, I will choose the debt ratio that minimizes my cost of capital subject to what I call a rating constraint, that my rating has to be at least single A or A- or BBB, because I need that to be a healthy going concern. So we're going to take both and work them through using Disney. So if you remember, Disney's optimal debt ratio is 40% at their existing operating income. But their existing operating income in 2013 came out of a very good year of operations. So I decided to take a look at Disney's past. And what was I looking for? I was looking to see what a bad year for Disney looked like. You think, I know what a bad year looks like. My operating income is going to decrease. That's true for every company. But for Con Ed, you know what a bad year in terms of operating income looks like? A 10% drop in operating income. They're a regulated utility. Their revenues are pretty stable. Their margins are kind of set. Their pricing passes costs on. So for Con Ed, a bad year is a 10% drop in operating income. But if you're a Dell or a Lenovo, a bad year for you can be a 40 or a 50% drop in operating income because you're in a risky business. So I wanted to see what a bad year for Disney looked like. And the best way to see that, given their history, is just look at their historical data. So this goes all the way back to 1987 through 2013. EBIT is, of course, operating income. And I look at the percentage changes in operating income by year. The worst year that Disney has had during this time period was 2000. In 2000, their operating income dropped by 29.5%. So I'm getting a sense of that is a really, really bad year. More typical for Disney is about a 10 to 15% drop in operating income. They're a company with enough diversification across multiple businesses that for them, you'd almost never see a 50% drop in operating income. I don't know what COVID did to them, but COVID, I think, clearly would have overwhelmed any of these things. So there's my change in operating income. So 2009, if you look at, if you go to, 2000 was the worst year. I also looked to see how sensitive Disney was to how the economy was doing by looking at recessions, 2009, 2002, 91. And you can see that recessions, for the most part, have a damaging effect on the company of about 20%, maybe 25%. I'm not looking for a specific number. I'm trying to get a sense of what does a bad year for Disney look like. And at least based on what I'm seeing in its history, you see a 10, maybe 20% drop in operating income. So here's what I did. I took that optimal capital structure spreadsheet, kept everything else fixed, and changed just the operating income. I made it drop by 10, 20, 30. And I kept track of what the optimal debt ratio was as I dropped the operating income. And I felt much better after I did this analysis about my optimal. And here's why. I was able to drop the operating income almost 30%, and my optimal debt ratio stayed at about 40%, which is my existing optimal. Think of it this way. You go in front of Disney's managers and you tell them to borrow $40 billion and buy back stock. And they say, what if something goes wrong? My response after doing this is, hey, I'm okay with something going wrong. Even if something goes wrong and your operating income drops as much as it did in 2000, which has been the worst year in history, you're still going to be okay with my optimal. That's not the case with every company you look at. For some companies, small changes in your operating income can cause your optimal to kind of implode on you, which means you have to be much more cautious at these companies about pushing the company towards its optimal debt ratio. So my optimal debt ratio is 40%. It seems pretty robust to big changes in the operating income. I then looked at the rating. And there's a reason. Almost every company I've ever talked to about capital structure has had a rating constraint. What does that mean? Most companies have a rating below which they do not want to drop. In the US, in fact, investment grade has become this line you don't want to cross in your rating. Investment grade is BBB. And the reason historically companies have been wary about dropping below BBB is when that happens, bad consequences emerge. Like what? It becomes much more difficult to raise capital. Those indirect bankruptcy costs we talked about, where customers stop buying your products, suppliers start demanding cash, much more likely if you're below investment grade. So most companies have at least an investment grade rating. Most have rating constraints which are set above investment grade. Some will say A-, maybe single A, to give themselves some buffer over the BBB rating. But once in a while, though, you will run into a company which has an absolutely unrealistic rating constraint. They'll say, look, we want to be AAA rated at any cost. And it leads to some really, if you think from a corporate finance standpoint, decisions that are not good for your shareholder. I'll give you a very simple anecdote to illustrate this. Is what 20 years ago, I was talking to the CFO of a European steel company, and it was the last remaining AAA rated steel company in the world. And the company was driven entirely by this fixation that the rating had to be AAA. So I asked the CFO, why are you so fixated on a AAA rating? And he said, because it allows me to borrow money at a really low cost. I said, that's interesting. He said, how do you maintain your AAA rating? You know what his answer was? We never borrow money. So this is the kind of circular reasoning you get into when you say, I want to have a AAA rating. And of course you can have a AAA rating if you never borrow money. But what's the point? I'd much rather you settle for a AA rating. We're able to borrow some money. I'm not asking you to go to single C or double B. Just go to a single A rating or a AA rating. And if you get a rating constraint, my suggestion is that you tell the management what it'll cost them to impose that rating constraint. And I'll do this for Disney, and then I'll take David's question. At its optimal debt ratio, Disney actually has a synthetic rating of single A. I feel pretty good. I'm feeling more and more comfortable with my optimal debt ratio, because not only is it robust to changes in my operating income, it also gives me a rating I can live with. Single A is perfectly okay for a company like Disney. If the manager insisted on a AA rating, it's okay. I'll look for a AA rating, and you can borrow up to 30% and get a AA rating. The cost of that constraint is when you go to 30%, you stop there, you end up with a higher cost of capital than at 40%. In fact, it's going to cost them about 5.7 billion. I'll give them the bill. You want a AA rated company? This is how much it's costing your shareholders. If they say we want a AAA rating, they can't get above 20%, because once you get above 20%, your rating drops below AAA. It'll cost their shareholders about 12 billion. Now you go in front of your shareholders and tell them that because you wanted to have this AA rating or AAA rating, it's costing them 5.6 or $12 billion. And if they okay it, I have absolutely no problem giving you a rating constraint optimal. David.
Yeah, what about banks and insurance companies who need to hold capital as a buffer, and that is determined by the rating of the company? So how do you
Financial
hold the
service
capital?
companies are unique. To begin with, I'm not even sure what debt means to a bank or an insurance company, right? Debt to them is raw material. It's not a source of capital. So for financial service companies, it's all about equity, and their ratings truly matter, because there are some things you cannot do without a AAA rating. So we're going to talk about Deutsche Bank and talk about how financial service companies approach debt. But for non-financial service companies, there is nothing magical about a AAA as opposed to a AA rating. You're really not gaining much as a company. There's not much. So it's not as if you, as a customer, go to an auto company and say, you're not a AAA rated auto company, you're only AA, I'm not buying your car. It doesn't matter. So for most non-financial service companies, the consequences of dropping below AAA are very, very small, non-existent. Thank God for that, because there are only a handful of AAA rated non-financial service companies left in the world still, partly because nobody cares that much about preserving that AAA rating. Any other questions? Which leads me to my final question, because at this stage, if Disney says, why should we do it? My answer is not going to be your cost of capital is going to drop by 0.65%. It's going to be your value will increase by 19.6 billion for your equity investors. If they ask me, what if something goes wrong? The 40% seems pretty buffered, right? You have a big drop in operating income, you can still maintain it. You still have a decent rating. And then they ask me a final question, which is, do I need to buy back stock? Especially because it seems silly, right? To borrow money, buy back stock, and then raise capital to build a new theme park or build a new streaming business. So the question I ask is, will our optimal be different if instead of buying back stock, I decide to take projects instead? I'll give you the easy answer first and the more difficult one later. The easy answer is no, your optimal will be your optimal as long as you stay with the same business mix. You know what that means, right? If they're borrowing money to build another theme park, expand broadcasting, I have absolutely no problem about them using the 40% as their optimal and moving forward with it. Because my assumption is as long as you stay in the same business, your cash flows will scale up. You'll just get bigger as a company, but your cash flows will stay up. But if they want to borrow money to expand the streaming business, I'm a little more wary, and here's why. The streaming business is not exactly a cash-rich business. What that means is, even if you take the biggest streaming company in the world, which is Netflix, and you look at its cash flows, it has negative cash flows. It makes money, but it has negative cash flows because the content cost at Disney is almost $17 to $18 billion. And when you drain those costs, it's a negative cash flow business. Streaming is a risky negative cash flow business. If you're going to borrow money to expand into a risky negative cash flow business, I don't think your optimal is going to stay at 40% because the additional risk and the negative cash flows will bring down your capacity to borrow money. What I'm saying is, if you're a company with excess debt capacity, I can't give you a blank check to go out and do whatever you want with that debt capacity. If you want to invest this money, I need to know where the investment is happening before I can put my stamp of approval and say, okay, you can use debt capacity to do that. So let's review. When you go to the optimal, you lower your cost of capital. But the real effect is a change in value that you get from going to the optimal. That change in value comes entirely from the tax law. But you didn't write the tax law, you're just taking advantage of it. Second, what if something goes wrong is really an assessment of what if there's a recession, what if my operating income drops? You're checking to see how durable, how robust your optimal is. And third, can you use this debt capacity to go out and take projects instead? Yes, as long as you're in the same business. You're not deviating on to riskier businesses. If you are, then you got to tell me where you plan to invest, and then I can go back and reassess what your optimal will be given where you plan to invest. Any questions on any of those, on any of those three questions? So that's the Disney analysis. Let's see if we can try this on our other companies. So I turned to Tata Motors, and I'm not going to take you through the whole mess again because you've seen the process, right? Basically, I changed the debt ratio. You can see my levered beta go up and my cost of equity go up. And as I borrow money, no surprise, my rating goes down for Tata Motors. There's my cost of debt. I'm doing everything in rupee terms. Tax rate is 32.5%. That's the marginal tax rate for India. But again, once you get above 50% debt, notice my tax rate decreases. That's because my interest expenses become too large relative to my operating income. My cost of capital, if you look at the second to last column, decreases as I go from 0 to 10 to 20. But once you get past 20, the debt rate, the cost of capital starts to rise again. The optimal debt ratio for Disney, for Tata Motors, is about 20%. Their actual debt ratio was about 29%. They looked a little over levered. They looked like they had a little too much debt. In fact, one of the interesting things that I did as a follow-up to this was I did this for Tata Steel, Tata Chemicals, which are also Tata companies, and they were over levered as well. Then I looked at Tata Consulting Services, which is the biggest part of Tata Motors, of the Tata Group, and they were significantly under-levered. So I had three companies that were over-levered and one company that was massively under-levered. This might be cynical of me, but it looks to me like the Tata companies are using other companies in the group as their basis for borrowing. No bank should ever do it, but banks know that the family is never going to let a company go down. So they're actually lending money on the basis of other companies in the group. Something we talked about early on in terms of corporate governance. But in this case, you can see Tata Motors is mildly over-levered. Its debt ratio is higher than its optimal. So you can use this on emerging market companies. You can use this in different currencies. The end game is you're trying to minimize your cost of capital. And that's all I'm doing here is changing the debt ratio to see where the cost of capital is minimized. Will this work on a commodity company? I don't see why not, with one caveat. Commodity companies, even mature ones, will see their operating income go up and down as the commodity price goes up and down. When I took Vale at the existing iron ore prices in 2013, the optimal debt ratio I got for Vale, and I did everything in dollar terms because Vale, commodity company, it made more sense to stick with US dollars. The optimal debt ratio was about 30% debt. So right now, Tata Motors was Disney was 40%, Tata Motors is 20%, Vale is 30%. We're going to come back in a minute and talk about why different companies have different optimals, but clearly already you can see three different optimal debt ratios come out. At a 30% debt ratio, their cost of capital is minimized. Incidentally, one thing you need to think about is I'm doing the optimals in 10% increments. You know what that means, right? So when I say the optimal is 30, I'm saying it's somewhere around 30%. It could be 33, maybe 34, it could be 26. In this case, it's about 30%. Their actual debt ratio was well over 50%. So if you look at their actual debt ratio, the question is, are they over-levered? Actually, the CFO of Vale was actually a student in this class in the late 90s. I don't know whether he's still CFO, but I reached out to him and I said, I've got your optimal here. It looks much lower than your actual debt ratio. What's going on? And he came back and said, that's because iron ore prices are low. And I said, okay, let's see if that's the case. So what I did was actually took the average operating income over 3 years, saying, look, maybe that'll capture the swings in iron ore prices. And based on that average operating income over 3 years, if I use that as my operating income, my optimal debt ratio is close to 50%. So it looked like Vale was borrowing based on what they made in a normal year rather than what the iron ore price was. The danger, of course, is if iron ore prices drop and stay low, you're going to be in deep trouble. And this has been the case with commodity companies. For a century, commodity companies have been managed based on a price cycle. You know what I mean by that? An oil company always assumes that prices are going to bounce back to $70, $75, $80 a barrel. And this has been true across commodity companies. What oil companies have discovered in the last decade is sometimes you're into a new trend, a new cycle, where your end price might not be what it was over the last century. That's always a danger with commodity companies that use a normalized operating income to go out and borrow money. So if you have a commodity company and 2020 was a bad year for you, don't be surprised if you get a really low optimal. Try using an average operating income over time, but be careful because that average might never show up if oil prices don't bounce back. And finally, I looked at Baidu, my young high growth company. Again, by now you see the process. I look at the beta and the cost of debt. Take a look at the second to last column, cost of capital. I go from 0 to 10%, my cost of capital decreases. And then very quickly it starts to rise again. So Baidu's optimal debt ratio is 10%. In fact, for some of your companies, the optimal debt ratio can be 0%. The minute you start to borrow money, your cost of capital pops up. It's a trade-off. And for Baidu, at least, the trade-off is very quickly turning against them. And their optimal debt ratio reveals that. Any questions about the process? The process is driven heavily by how much money you make as a company, not what your assets look like, what you're borrowing, but do you have the capacity to make your debt payments? And Baidu actually had an actual debt ratio of 5%, which when you first looked at it, you said, that's a really low debt ratio. But it turns out your optimal is 10%. You're not that far from the optimal. Remember, at 10%, it could be 6 or 7. So Baidu borrows very little money, but I think it's doing the right thing, given that it's a young growth company. And finally, I turned to Bookscape, my private company, saying, can you do an optimal debt ratio for a private company? Why not? I want to minimize my cost of capital, even if I'm the owner of a private business. What I did differently was I did use the total beta to come up with the cost of equity. Because remember the Bookscape, you said the owner's not diversified, sees all risk in the company. But the rest of the process looks pretty much like it did for a public company. One number I did not have for Bookscape, and this is always the case when you try to do the optimal debt ratio for a private company, is I didn't have a market value of equity because the shares are not traded. So I cheated. I took the net income and estimated what the equity value would be by just applying a PE ratio based on publicly traded companies in that space. It doesn't matter that much. It just gives me a base estimated value. My optimal debt ratio for Bookscape is about 30% debt. They were actually at a 27.8% debt ratio. So Bookscape looks, so here's what we have. Disney looks under-levered. Tata Motors looks over-levered. Vale looks over-levered if you use the current operating income, but okay if you use a normalized operating income. Baidu looks very close to its optimal at a 10% debt ratio. And Bookscape looks like it's okay in terms of debt financing. That's really the question you're asking about a company. Does my company have a debt ratio that should scare me? Or should be an opportunity if it's too low, or it should scare you if it's too high? And that's the end game that we're going for here. We're in the cusp probably of another big tax reform coming about. But the last one that happened in 2017 was perhaps the biggest change in corporate taxes in the last 50 years. And it did a couple of things. One is it changed the marginal tax rate substantially from 35% down to 21%. We talked about this, right? The tax benefits of debt overnight have decreased. And it also introduced a limit on interest expenses. It said interest expenses up to 30% of EBITDA could be tax deductible, but if they exceeded that, you'd lose the tax deduction. Both changes are going to make debt a less attractive option because they're taking away the primary benefit of borrowing money, right?
Yeah, I'm wondering at what point wild swings in equity values in a company would negate this process. Like I'm doing NVIDIA and they've appreciated 30% in the last month.
Okay.
So would that?
I'll make a
not
prediction.
totally-
Your debt ratio will swing, but your dollar debt will not. And here's why, because I'm basing how much you can borrow on your EBIT. If your EBIT's not swinging wildly, the amount of debt I can take on is also not swinging wildly. The reason your debt ratio is swinging is your market cap goes up and down. Because at the end of my Disney analysis, I targeted a dollar debt of 55 billion. If Disney's market cap doubled overnight, my optimal debt will still stay 55%, even though the debt ratio becomes 20%. So I would worry less about the swings in the debt ratio and more about the difference between your current debt and the optimal dollar debt that you have for your company, because that difference will stay pretty stable if your operating income stays stable. So I actually, after the 2017 Tax Reform Act passed, I took Disney and I ran 2 capital structure spreadsheets, one with the old tax regime, where the tax rate was 40% and interest expense were fully deductible, and the new tax regime. See the orange? That's under the old tax regime, the 40% tax rate. The gray is what happens when I take Disney. All the numbers stay the same and just change the tax rate. The optimal actually stayed roughly the same. But you see what's changed? With the old tax law, look at how much the value of the firm increases as my debt ratio goes up. With the new tax law, it kind of levels off between 20 and 40%. So in other words, if you ask me as Disney, what is different after the tax law changes? With the old tax law, I'd be pushing them strongly towards a 40%. With the new tax law, once I get to 20%, I'm going to say, you know what? You're pretty close to your optimal. Just let it go. So what the new tax law effectively has done is lowered the tax benefits of debt for every company. Might not have lowered the optimal debt ratios, but lowered the tax benefits of debt. And one of the things I've been keeping track of is whether companies are behaving accordingly. In other words, are you seeing a drop-off in how much companies borrow after the 2017 tax law? And so far, at least, the answer seems to be both yes and no. You can say, how can it be both yes and no? If you look at dollar debt, so this is total debt with and without leases, 2017, 18, 19. So 2017 is the pre-tax law change. 2018 is the post-tax law change. Clearly, there's not a huge drop-off in debt. In fact, if anything, debt continues to rise in 2018 and 2019. But if you look at debt as a multiple of EBITDA, which is basically, that number has decreased between 2017 and 19. I still think US companies should be borrowing less money. Post 2017, they should be borrowing less money. Why aren't they doing it yet? Because inertia drives this process. Companies do what they've always done. Unfortunately, we won't get a chance to track this for the next 6 or 7 years, which is what you'd like to see, right? To see if it happens. Because my guess is the tax law will change again this year, and God only knows what that'll create in terms of an adjustment process in terms of 4 or 5 years. But the benefit of debt still remains a tax benefit. And every time the tax rate changes, you're going to see that play out. Any questions on the process of using cost of capital to come up with the optimum? Now, that approach is a pretty straightforward approach, but I'm going to be honest about the limitations of the approach. So first is, it's static. I'm using last year's operating income, and I'm playing all these games of what can the company borrow based on last year's operating income. Second, it ignores indirect bankruptcy costs, right? Remember we said as your rating drops below a certain level, at least BBB, BB, your revenues start to be affected. I kept my revenues, EBITDA and EBIT the same as I went from 0 to 90% debt. And third, I'm building my cost of capital of a levered beta where I assume that debt carries no risk and a synthetic ratings process. So you can pick it apart. I don't like this, I don't like that. And I am going to offer you an alternative, which is built into your spreadsheet right now, which allows you to at least deal with some of the problems. And here are the things I'm going to modify. In the old spreadsheet where I minimized the cost of capital, I just looked for the lowest cost of capital and I used it. But my operating income and cash flow stayed the same at every debt ratio. Teresa, I'm sorry.
Yeah, I just had a quick question about
Yeah.
if you saw a company that had a much lower
debt to capital ratio than what you would expect. Like, do you have a set of assumptions that you generally would go to understand that? For example, like analyzing the New York Times, their debt to capital ratio currently is like 2%, and its optimal, I think, should be like much higher. So like, just curious if you have like a general set of questions that you would.
We're going to ask the question. In fact, that's one of the things we're going to look at after we've done the optimal is for most big companies, there's going to be a gap between the actual and the optimal. Some of you are going to be under levered, some are going to be over levered. The over levered, you can point to and say maybe they made a mistake. If it's under levered, they've always been under levered. The question you ask is what's holding them back? So we're going to look at a series of reasons. And I'm going to argue that many of these companies you're going to leave well enough alone. That increasing the value by going to the optimal comes with such consequences that you want to push that. In fact, with the New York Times, let's say their optimal is 20%. I don't know what it is, but let's say it's 20%. They're at 2% debt. Why might you not want to go to the 20% debt ratio?
They might have like future projects that they want to take on, but don't want to commit to them now,
And
or their
let's
business
face it,
plan will be changing.
this is now a business that's a technology business, right? It's digital, it's shifting. There are all kinds of new investments they have to make. The last thing they want to do is lock themselves in by going out and borrowing money and say, oh my God, what do we do now? So the more uncertain you feel about the future, the more likely it is that you will hold back. Okay? The second is, who controls the New York Times? It's not really, it's a publicly traded company, but it is controlled by a family, right? I mean, they've essentially viewed it as a family company. As a family, they're probably overinvested. If you look at their portfolios, 80% of the portfolio is in the New York Times. If it goes down, there's no diversification they can draw back on. The family's wealth is tied too much in this company. And if it is, you're going to hold back on debt. The last thing you want to do is put that family legacy at risk because you don't have the luxury of losing everything on this and trying to come back. So I can think of at least a couple of reasons the New York Times would hold back. Okay? But there are other companies we might not be able to find any good reasons. In which case, why they're holding back? Because they're just inertia. They're just stuck in whatever they're doing and they don't want to borrow money. But we're going to give the company the benefit of the doubt and say, what am I missing here? Rather than jump to the conclusion that they're stupid and crazy and they should borrow more money. Right? Because in most cases, that's probably too rash a judgment to make. So in the enhanced cost of capital approach, here's what I'm going to do. First, I'm going to tie your operating income to what your rating is. So if your rating starts to drop below BBB, I'm going to say, you know what, that's going to cost you. Your revenues are going to be affected. Your operating income is going to be affected. So I'm going to allow for that. The second is, if I really am concerned about the fact that I'm using last year's operating income, and that number is a shaky number, it's volatile, I might consider making it a distribution. Remember how we talked about Monte Carlo simulations when we did investment analysis? There's no reason why you can't make your optimal debt ratio also a Monte Carlo simulation. So let's start by looking at how distress plays out. So it was this, about 25 years ago, I started collecting data on companies who got downgraded. And then looking at what happened to their operating income in the year after, 2 years, I wanted to see what the consequences were to the company's revenues and operating income of getting downgraded. And here's what I ended up with this as a table. And this is across all companies. I divided them into 3 groups because it looked like in some companies, the effect of a downgrade was much smaller. In these companies with low indirect bankruptcy costs, they could get all the way to BBB. Maybe there's a small drop, but basically this is the drop in EBITDA if they lose their rating. So if they go to BBB, they lose 5%. If they go to BB plus, it's another 10. So each time the rating drops, their operating income drops. If you're in the middle category, the drop is much greater. And if you're in the category where the indirect bankruptcy costs are very large, remember we talked about if you make durable goods and your customers stop buying your product, the drop is even higher. So here's what I'm going to do. As I do the optimal debt ratio, if you ask me to do this, I'll also start adjusting your operating income as your rating increases. So in addition to your cost of capital changing, your numerator is also changing. So I tried this on Disney to see what would happen to their optimal. So think of what I did for Disney, right? The original analysis, I kept the operating income fixed and changed just the debt ratio, only the cost of capital changed. Here, in addition to the cost of capital changing, my cash flows are also changing. My end game is to maximize my value as a company. And if I make that my end game, it turns out that my optimal debt ratio is still 40% with the indirect bankruptcy cost built in. But in some companies, when you bring in these distress costs, what you're going to see is your optimal starts to shift lower. Why? Because you don't want to get to that 40%. It's too consequential for you. And even in the case of Disney, I create this huge fall off after 40%. The consequences of getting too close to the optimal and going over are so catastrophic that if Disney asks me, I'm probably going to tell them, stop at 30, don't go to 40 because you're too close to the edge if it happens. So the enhanced cost of capital approach is actually built into that capital structure spreadsheet that I sent you. It's two options. One is I said, do you want me to bring in indirect bankruptcy costs? So you say yes. Then I ask you, is it low, medium, or high, depending on what you think your company is. And if you pick that option, you're going to see your income and cash flows also change as your debt ratio changes. And that'll give you this more complete approach. So I've covered.
Excuse me, Professor.
Yes.
Why does the, if you could go back to the previous slide, why does the tax rate change?
Because once I get beyond a certain point, I don't have enough operating income to cover my interest expenses, right?
Okay. So it
Remember that
factors in a lot.
so once that happens, I say, look, I can't give you the full 36% tax benefit. I'm going to start to reduce it. So it's not that the tax rate is changing. I just run out of operating income to cover the interest expenses.
Thank you.
Finally, let's talk about banks, insurance companies, investment banks. As I said, debt ratio for a bank means very little. Debt to a bank is raw material. It's not a source of capital. So the bank, when you ask, do you have enough debt? It doesn't even make sense. But I can ask a different question at a bank, which is, do you have enough equity? Equity is regulatory capital. And if you don't have enough regulatory capital as a financial service company, you're flirting with disaster. So what I'm going to do when I look at a financial service company is I'm going to focus on equity and ask, do you have enough equity? And if you don't, I'm going to argue that you need to bring in fresh equity. So it's really with banks, capital becomes equity capital. And the question you're asking is, does this bank have enough equity capital? Incidentally, if you as a bank don't ask a question, the regulators are going to ask you this question, do you have enough capital? And if you're an undercapitalized bank, guess what they're going to make you do? They're going to make you raise capital to make sure you get back to that steady state. So let's talk about how this would work with a very simplistic example. Let's think of an old-fashioned bank. You know what an old-fashioned bank does? People come in, they deposit their money at the bank as fixed deposits and checking accounts. The bank then takes the money and loans it out. And it makes money on the spread between what it receives as interest income and what it pays out as interest expenses. So let's say your bank has 100 million in loans that it's made, and it has a book equity of 6 million. Let's assume for the moment book equity and regulatory capital are the same. So right now it has a 6% equity capital ratio. The regulatory requirement is only 5%, so they're more than they need, right? They're at 6%. But this bank is conservative. They say, look, we don't want to be at 5%, or even at 6%, we want to be at 7% of loans outstanding. And they're also growing at the same time. Let's see how this plays out for the bank, right? If they grow 50% a year, next year they have 150 million in loans outstanding, 100 growing at 50%. 7% of 150 is 10.5 million. They will need 10.5 million in equity next year to meet their 7% requirement. Right now they're at 6 million. They need to make up the difference, which is $4.5 million. So let me ask you a question. As a bank, you know you got to come up with $4.5 million in additional book equity next year. What are the pathways by which you get that book equity? What's the most normal way in which banks increase their equity? Happens every year. What do? Remember, it's book equity. So every time you retain earnings, it increases your equity, right? So if you have net income of 3 million and you pay out 1 million dividends, that'll increase your book equity by 2 million. So the first place I'm going to look at is, do they have enough earnings to cover this 4.5 million? Let's say they can cover 2 out of the 4.5 million with retained earnings. That still leaves you with $2.5 million to come up with. You know what the bank has to do? It has to go out and raise equity. One reason the Fed had such tight restrictions on dividends and buybacks at US banks post 2008 was to make banks do this, force them to put their money back to increase their capital ratios, because the Fed was worried that banks were undercapitalized to cover something like 2008. I think the final constraints were relaxed just a few weeks ago on banks. It took 12 years before the constraints were removed. But with a bank, an insurance company, and an investment bank, rather than focus on debt to equity ratios, focus on equity, book equity, maybe even regulatory capital ratios, and think about whether the bank is under or overcapitalized. But capital here is basically talking about equity capital. In 2013, I took a look at Deutsche. And Deutsche is a bank I revisit every few years. And in 2013, Deutsche was in trouble. It had negative return on equity. And in this table, all I've done is estimated how much they will need to, and they were undercapitalized. So basically, as a bank, the point I made was, look, Deutsche has to go out and raise its capital ratio over time because they're undercapitalized. And what you see here is investment in regulatory capital is what I'm estimating Deutsche has to come up with because they're an undercapitalized bank. Now, later on, when we talk about dividend policy, we'll talk about how this plays out, but you can see the effect. Given my view on Deutsche, which is it's undercapitalized, not only can they not pay dividends, but they will have to go out and raise about 3.9 plus 2.6 plus almost 7.5 billion euros in fresh equity over the next 3 years to get themselves to a debt ratio that I feel comfortable with. Now, in India now, a lot of banks are facing issues because a lot of Indian banks have bad loans that they've never quite admitted to, mostly to family groups. And now as those loans get written down, these banks are getting undercapitalized. So if you ask me, what does an Indian bank have to do on capital structure? It's very simple. They need to raise their book equity, which means they don't have the net income. They have to raise fresh equity. They have to issue shares to cover that deficit. And if you're an overcapitalized bank, I'm going to cut you slack. I'm going to say, look, you can get away paying big dividends and maybe even buying back stock because you have the capital to be able to do it. Any questions about capital structure at a bank?
I guess Deutsche doesn't have any like retail banks in the US, but they obviously do in Germany. How do banks like decide to open up like another like brick and mortar location? Because they have to be losing like a ton of money every time they do that. Like
I don't even know. When I look at these physical locations for banks, when was the last time any of you was actually in a bank? I can't remember the last time I actually went into a bank. Right?
You needed something notarized.
Maybe we get something notarized and you get a free notary, right? But you're not doing any, and usually it's free, right? That's the reason I go into my Chase. You're right. I do go into Chase to get something notarized. They get nothing out of the transaction. So it strikes me as strange that we have so many physical locations. It must work. I don't know. It's either insanity or there's something else happening in that building that I don't know about. But I think from the perspective of investing, I don't see how these physical locations act. And that, because every bank might be doing it, they might be able to get away with it, but they're exposing themselves to these fintech companies that don't have the same infrastructure costs that can now come after them and do things for a fraction of a cost. I mean, most of my banking now is through Schwab. It's not through JP Morgan Chase because almost every service I use with Schwab Bank costs me less than it cost me with JP Morgan. I'm not blaming the physical locations that JP Morgan has for that. But I think by having that cost, they might be putting themselves at a significant disadvantage in some parts of the banking business. But maybe I don't know enough. Maybe there are people who still go into banks, and maybe it's enough to cover the cost, but I really don't quite understand that, what's driving it. So as a bank, then here's something to remember. Remember that banks have always had this issue of having to maintain capital to cover potential losses. You're saying, but that's because a regulatory authority requires them to. Banks predate regulatory authorities. The Rothschilds built one of the great banks of the time in Europe in the 1400s and the 1500s. There was no regulatory capital requirement. But they were sensible people. They set aside a portion of their capital to cover what they felt would be losses on their loans. So what I'm trying to say is we think of regulatory capital requirements when we think about banks, but that should be a bare minimum. Banks need to think about their own risks and bring in the capital to cover their risk. This is not a game where the end objective is to fool the regulatory authorities. It's a process by which you want to have enough capital to cover your future losses. So when you look at banks, one of the things to look at is the regulatory capital ratio. So S&P Capital IQ, for instance, is tier 1 capital in every bank. You can check to see which banks are overcapitalized, which are undercapitalized. You can compare them to the regulatory capital ratio requirement. But what you're going to find is there are conservative banks out there, and there are banks that flirt with being at the very minimum. And all you need is one shock for those latter group to end up being below the line. So let's end today's session by talking about what it is that drives the optimal. Even among my companies, we think about it, with Disney, I got 40. With Vale, I got 20% as my optimal. With Tata Motors, I got, so basically with Tata Motors, I got 20%. With Vale, I got 30%. So with each company, I was getting a different optimal. Saying, what's driving those differences? Now, many of you, if you look at your group and you have 6 companies in your group, don't be surprised if you get optimal debt ratios ranging from 0 to 50% for your companies. So I'm going to give away what's driving those differences. Here's the first one. It's a tax rate. That tax rate comes from the corporate tax code. But if some of your companies are in countries with really high tax rates and others are in countries with really low tax rates, so let's say you're doing airlines and Ryanair is one of the companies in your group, I would predict that Ryanair will have a much lower optimal debt ratio than United Airlines. In fact, I took my 5 companies, changed the tax rate from 0 to 50%. And as I changed the tax rate, at a 0% tax rate, every company's optimal is 0. You can try this out with your company. You make the tax rate 0%, the optimal debt ratio will go to 0%. As my tax rate rises for Disney, the optimal goes from 0 to 40%. It caps off because at some point, borrowing more doesn't help you that much, even with high tax rates, because you don't have the income to cover the interest expense. But with every one of my companies, higher marginal tax rates lead to higher optimal debt ratios. Here's the second factor. So you're looking across companies, let's say they're all US companies. The marginal tax rate in the US, assuming that nothing else changes in the corporate tax code over the rest of this year, is about 25%. It's 21% at the federal level plus state and local taxes, 25%. So 5 US companies, they all have 25% tax rates. So taxes are not the difference. So why are the optimals different? Here's the second thing to look for. I told you that my approach to coming up with the optimal is to look at how much the company makes, how much it has in earnings and cash flows. The more a company generates as earnings and cash flows relative to its market value as a company, that's a key. The higher that percentage, the more it can afford to borrow. So let's try this. If you take Disney, $12.5 billion in EBITDA as a percentage of enterprise value, it's about 9.35%. For Vale and Tata Motors, that number is closer to 18%. For Baidu, that number is only 4%. Why? Because the market value is much higher if you're a growth company. And if I look at how much you have as earnings and cash flows, and that's a small number relative to your market value, your optimal debt ratio is going to be a low number. Those of you looking at tech companies, Apple, Facebook, let's say you pick Fangam as your group, right? Facebook, Apple, you know what you're going to find is the optimal debt ratio for all 6 of these companies. And I make this safe prediction even without looking at the numbers. Your optimal debt ratios are unlikely to be higher than 10 or 20%. And here's why. What's Apple's market cap right now? About $2 trillion. Think of what 10% of 2 trillion is. That's $200 billion. 10% doesn't sound like much, but if your market cap is 2 trillion or 2.5 trillion, getting to 10% is already a huge amount of debt. A 20% debt ratio for Apple is $400 billion in debt. No company in history has been able to carry that much debt. Don't let the percentages get in the way of you thinking about how much is my company borrowing. And if your company doesn't have enough cash flows as a percent of value to sustain that, your optimal debt ratios are going to be really low. That's why for some of your companies, your optimal debt ratio is going to be 0%. It's not because you've made a mistake, but you're even getting to a 10% debt ratio of your company is putting them at severe risk. And finally, risk matters, right? Riskier companies, holding all else constant, should have lower optimal debt ratios than safer companies. And there are two inputs in your calculation that will capture that. One is that unlevered beta that you have as a company. Companies with higher unlevered betas, you're going to find have lower optimal debt ratios than companies with lower unlevered betas, because that leverage effect kicks in. And the second is, even though I've used one lookup table for most of your companies, you could argue that if you're a safe company, you get a higher rating for the same interest coverage ratio, which allows you then to go out and borrow more money. So look at differences in tax rates. Look at differences in how much your companies generate as cash flows relative to market value. And look at their risk as companies. And for most of your companies, you can very quickly see why they have different debt ratios. The only macro variable that seems to drive optimal debt ratios is the price of risk in equity and bond market. Let me step back. Remember when we talked about equity risk premiums? I said this is the price of risk in the equity market. So if you look at this graph, the red line is my equity risk premium going all the way back to 1960. It goes up and down. You get the dot-com boom, it went down to really low. So the red line is my equity risk premium. The black line is the default spread on one ratings class, BAA, which is an investment grade bond. So that line also goes up and down. Most of the time, the two move together. When the price of risk goes up in the equity market, the price of risk also goes up in the bond market. Price of risk in the equity market drops, the price of risk in the bond market also drops. But there are at least a couple of times in the last 30 years where the two have moved in different directions. Here's the first one. Go back to the late 90s. Take a look at what's happening to the equity risk premium. Take a look at what's happening to the bond default spread. In 1999, you're the CFO of a company. You say, I can raise equity or I can raise debt. Think of what you're facing. In the equity market, investors are demanding almost no risk premium. You can go out and raise money. People are settling for 2 or 3% equity risk premiums. Money is cheap in the equity market. You go to the bond market in that same period, let's say it's 1999. It's costing you about the same as going to the equity market. No wonder in the late 90s, you got this boom in equity issuances. Lots of companies, even if they didn't need the money, went out and raised equity because it was cheap relative to debt. You move forward 4 years later, you have the golden age of the LBO. Why? Because equity risk premiums are high, bond default spreads have dropped to historic lows. So if you went out and borrowed money, people are not charging enough of a default spread, but you were paying a high price in the equity market. I remember in 2006 and 7 in this class, people were coming back with optimal debt ratio of 60 and 70% for many companies. Why? Because at the price of risk then, it actually made sense to go out and borrow money because you were paying such small default spreads. We're not in one of those unusual times right now, so I'm not expecting to be a dominant force, but something to keep track of over time to understand why capital structures vary over time. So I'm going to leave you with the task, and it's something that, if some of you have already done, I know you've sent me your capital structure spreadsheets. Take that capital structure spreadsheet, because I've done in that spreadsheet basically what I did for Disney, Tata Motors. It's kind of mechanized. It's not rocket science. You can build a spreadsheet yourself. It's not a big deal. But since I want you to focus on doing this for your company, I want you to estimate, for your company, given its numbers, what its optimal debt ratio is, what the cost to capital will be at the optimal, what will happen to the value of your company. It'll all be given in the spreadsheet as output. You're saying, then what do I do? I want you to think about why your company has the optimal that it does. Let me emphasize that again. I'll do the number crunching part. But when you look at your company and you say, why is my company's optimal X%? I want to think about, is it the tax rate? Is it the cash flows? So whatever the number is, I want you to think of the intuitive basis for that optimal. I don't want to make Michael, put him on the spot. Michael's one of the people who sent me his spreadsheets, so for Coca-Cola, what was your optimal, Michael?
It output something like 10%, but I think it was closer to 15%.
Okay, so so in the spreadsheet it said 10%. In fact, I'm going to use it because it's something that many people in this class are going to run into. The optimal debt ratio came up for Coca-Cola was 10%. Coca-Cola's actual debt ratio was 17%. And here's why Michael sent me he said the reason he was a little confused when he first looked at the output of the spreadsheet is his cost of capital at a 17% debt ratio was actually lower than the cost of capital at what I call the optimal, which is 10%, right? And the whole idea of the optimal is you want to lower the cost of capital. He said, what's going on here? I'm at 17%, the optimal is 10%, but the cost of capital actually looks higher at 10% than in my existing debt ratio. Michael, do you remember the answer I gave you? You probably have worked this through. What's the answer to explaining that contradiction?
Yeah, the answer is that the spreadsheet only calculates in increments of 10%. So 10% means anywhere between 10 and 20%, but it could be
which means at 17 you could be closer to the optimal than I computed. So if any of you come up with an optimal debt ratio where your cost of capital is actually higher than it is in the existing debt ratio, don't freak out. It's not the end of the world. Take a look at that spread and see if it explains it. Whitney?
Yeah, I have a question on the tax rate. Sorry, I'm having a hard time wrapping my head around. When your interest coverage ratio is lower than 1, then wouldn't it mean that you have negative earnings? And then why are you still paying taxes? Is it because taxes are on operating income?
Well, even if your interest expenses are less than 1, it doesn't mean you don't get a tax deduction. You get it up to the interest. So let's say that you have $1 billion in interest expenses and $500 million in operating income. You still get the tax benefit of the first $500 million, right? It's not that you didn't get any tax savings. Because think of what would have happened if you had no interest expenses. Would you have paid some taxes? With $500 million in operating income, you'd have paid, let's say, a 40% tax rate. You'd have paid $200 million in taxes, right? Now I introduced a bill. So you still save taxes, right? The question to ask is, what if I did not have this interest expense?
Right. No, my question is like, why is the tax rate like 20% versus 30%? Like if you don't pay taxes, wouldn't it be like 0%?
Because that tax rate is how much you're saving on your overall interest expense. So if you have $1 billion in interest expense and it's saving you $200 million in taxes, which it is, in effect, it's still getting your tax benefit. It's not a 0 tax benefit. It's still a 20% tax benefit because you got the tax benefit on the first $500 million and then you ran out of income. So what I'm computing is, what did you get as a tax benefit on that entire expense? And there's still a tax benefit even though you're a money-losing company.
I see. Okay, thank you.
The easiest way to do it, act as if you have no interest expense, see what your taxes would have been, and then you're going to see that there's still a tax savings. Any other questions? Okay, folks. That's about it, and I will see you on Wednesday. Take care.
Thank you.
Bye.